Thank you for joining this Blockchain Co-Investors webinar. Today, we're going to talk about the underlying investment themes that we're focused on within this space. This is an educational webinar, and even though I have to show you this disclaimer page, the most important part is that this is purely educational. We will not be making any solicitations for any of our funds during the course of this webinar. This is our vision. We have held the view that digital monies, commodities, and assets are inevitable, and that we will be needing to upgrade the world's financial infrastructure to cope with them. And I'll make some observations today about recent events, but suffice to say that we believe more than ever in this future and in the need for us to have a better global financial infrastructure than we do today. Our mission is to provide the broadest possible coverage of the emerging unicorns of the space, but do so in the early stage. And we do that through our focus areas of early stage venture investing into the space through a very large global and diversified portfolio of investments. We do have an integrated investment platform. We have a number of funds. Our fund of funds are the anchor of what we do. Each one of them provides diversified access to leading blockchain VCs globally. And our latest fund of fund, Fund 7, will be launching in the next month or so. And then we have two direct funds, an early stage token fund and a mid-stage growth fund that take advantage of the privileged access we get from our position in the ecosystem. These are some key metrics. We are fortunate to be investors in more than 40 of the leading blockchain VCs, and our combined portfolio is more than 750 companies across our fund of funds, and about 55% of the blockchain unicorns with that access mostly occurring in the early stage. And performance has been exceptional. This is our first fund of funds, which continues, despite the ups and downs of last year, to be the highest performing fund of fund, according to Preqin and PitchBook in its category. Unicorn coverage is one of the things that we focus a lot on. This is an area that has given birth to many of the most valuable private companies in the world. More than 100 enterprise unicorns and 45 at the time that this page was created, projects trading at $1 billion and more. This is at the end of last year. Since then, there's been quite a bounce back. And by the time we get to the middle of this year, when we'll run this analysis again, I'm sure we'll have a lot more than 45 of the projects worth more than $1 billion. Importantly, we are not traders. So even though we've been reading, all of us, about certain issues amongst public liquid crypto and the trading of it, that isn't what we do. We're early stage venture investors, very traditional in what we do, and very familiar to all of you who are familiar with venture capital. So today we're going to focus on the investment theme. And this is the summarization at a high level of our investment thesis. We do believe that the internet did digitalize most of the world's communications and content, and that proved to be the greatest value creation event so far. I will show you a little bit of evidence about that. However, most of the world's commerce, monies, commodities, assets, and the transactions associated with them are not yet digital. More than half of it is still paper-based, and that means we can't get to a global digital economy. And so the second shoe is now dropping as we digitalize the world of commerce. But the challenge is that you can't handle digital commerce unless you upgrade the financial infrastructure. And so since businesses, individuals, and governments transact all of the time, it's a true horizontal. We believe this will be even bigger in terms of unlocking value than the internet was over the last 30 years. You can read more about the investment thesis in our book, Blockchain Competitive Advantage, which is available everywhere. And certainly you can find it on Amazon in all of its formats. But let's start here. This is the internet rise and fall and rise again that we all lived through over the last few years, the last few decades. You'll recall that back in the mid-90s, there was a lot of noise about electronic commerce and the arrival of the internet. People didn't really know what it was or what it would be put to in terms of use cases. By the mid-90s, after a period of very low interest rates, Alan Greenspan was beginning to warn of irrational exuberance. Money was cheap and prices were being bid up in those second half of the 90s. We began to see a few of the leading electronic commerce companies going public. Amazon is the example shown there in 97, May 15th, 97. And it rose very fast, both on the day of its IPO and in the weeks and months that followed. By March 2000, the Nasdaq had set an all-time high at that time, and then it collapsed very fast. And a lot of companies that had been able to go public with very little in the way of revenue and cash flow suddenly found their valuations plummeting. And without question, there was a lot of chaos. A lot of people said the internet was just a fad. In fact, there's a very famous front page article from one of the leading newspapers at that time saying just that the internet was a fraud and now it's all over. But of course it wasn't. The underlying innovation continued to play out. Amazon went to even higher all-time highs. And if you had hung on to it, your Amazon stock, you would have looked at a 300x return since then. And that is a fundamental surprise that we all lived through. But there was something more profound at work. And that is that there was an entire technology stack that had been built in the 90s and the zeros and continues to be built upon. And we called it the internet. The internet is sort of short form for all of these things. And it's not one thing. The internet is not one thing. It is a compounding of many innovations taken together. Down at the base, this is very simplified, but at the base of the technology stack, the foundational layer, there were some protocols and some platforms. The protocols in the bottom left-hand corner, TCP/IP is the one we know best because it sets some of the rules for the movement of information. But there's a number of other critical protocols required to make today's internet operate. In parallel, we were doing a number of things at the foundation layer with computing itself. We were making devices smaller and more powerful as Moore's law continued to operate, and we were beginning to network them together. And eventually, we migrated to the cloud, a distributed but centralized cloud. And we needed to build new registries and identity solutions, things like ECAN, in order for us to find our way around the internet. And on top of all of that, we built a transactional layer. And these are examples of browsers, search engines, crawlers, scrapers, bots, everything that was required to identify and move content around the internet. On top of all of that, we built applications, B2C, B2B applications, and almost all of us and almost all businesses now rely upon the internet for doing our work. So that was the simplified internet technology stack. The adoption curve of the internet was rapid. This is just showing from 1990 to 2020. Of course, it's not complete. So even today, only about 2/3 of the world's population have any type of access to the internet. In many parts of the southern continent, that is through cell phones. They don't have wired computing and high-speed linkages yet. And so there's still a lot of adoption still to occur, even around simple things like buying something at Amazon or sharing some information on a social platform like Facebook. It did create the greatest wealth creation ever. This is the list of the most valuable companies in the world. About half of them are internet or technology enabled. In fact, all of these companies, as I mentioned, rely upon the internet today, even if they're old-fashioned companies like Johnson & Johnson or ExxonMobil. So that was what we accomplished over the last 30 years. The last 20 years, connectivity, accessibility, interactivity enabled by a set of protocols that were focused on communication and content sharing. The problem is it wasn't built to be a commercial platform. Today's issues are a result of the reality that the internet was not intended to support commerce. It's highly insecure. It doesn't have a good system of identity and trust embedded in it. It's become increasingly concentrated, and the world's leading governments and legislators are concerned about that in North America, Europe, and Asia. And of course, for our investment thesis, it relies upon old world payments and old world assets. And as I've already mentioned, even though some of the payments may be in digital version 1, almost all of the world's assets are still paper-based in terms of their ownership records. So the next 20 years is going to be focused on us solving those problems. The next 20 years, we will have to build new digital infrastructure. We'll need to upgrade the global financial system, and that will allow us to move to a true digital economy. Blockchain plays a key role in that because it is a technology that has proven itself able to support the possession and transfer of value. And whatever you think of the early proof of concepts, things like Bitcoin, you may not like them, you may not particularly believe in them, but they do work in the sense that they are global peer-to-peer ways to transact value. And old technologies have not been able to do that, neither with the accessibility nor at very low cost and very fast speeds. So today we're able to do things in ways that the current financial system is not able to support. The adoption curve of blockchain, and this is a proxy, we view crypto as simply a subcategory within digital monies, commodities, and assets. We don't think that all digital monies, commodities, and assets will be distributed and decentralized by any manner. Many of them will be centralized, such as digitalized fiat currencies, also known as central bank digital currencies. But the point is the adoption curve of crypto by itself is running ahead of the internet's adoption curve. And you can see that here if you compare the pale blue line, which is the new adoption curve, with the dark blue line, which is the one that I just showed you a moment ago, the global internet adoption curve. And we think this will accelerate, and the reason why it will accelerate is because the adoption is concentrated in the digital natives who are 45 years and younger. If you take that pale blue bars here and you add on about half the dark blue segment, you essentially have the digital natives. And if there's one thing we know, it's that digital natives want and prefer and rely upon digital ways of transacting and investing and holding their money. And of course, they're getting older every day, so the adoption will naturally go up. So that then brings me to this technology stack. I showed you the internet technology stack to give you a sense of why we operate and think about our investment themes around a technology stack. This is the blockchain technology stack. So once again, down at the base, we have a foundational layer, and we have 3 things that we focus on. The first is the protocols and the software, open source software development platforms that are rolling out today. Secondly, we are very interested in the continuing migration of computing. And we think there's a possibility that sizable blocks of the world's computing activity will move beyond centralized distributed cloud computing to decentralized distributed cloud computing. There are some advantages about being able to access computing power of many, many decentralized devices. And we're beginning to experiment with that around the world. Networks, registries, and identity solutions is one of the biggest single problems of the internet today. And we think blockchain does a great job of improving identity in immutable, secure, and portable ways. At the transactional layer, we're talking about the internet of value. And for us, it's quite simple to think about that as being either institutional or retail focused. And then in the middle, we have this notion of peer-to-peer, disintermediated peer-to-peer, supported by computing software. And that's also known as DeFi. And then up at the top, we may be old-fashioned, but we tend to also think about applications as being B2B oriented on the left or B2C oriented on the left or B2B oriented on the right. And we're seeing a lot of those surface. Examples, there are many. Many of them are early stage companies beginning to get traction, but there are important use cases surfacing, and we'll talk about a couple of those in the next few pages. So what I'm going to do now is briefly talk through what these 8 investment themes are about. And these are, in fact, our 8 investment themes. So first, talking about protocols in the bottom left-hand corner of the foundational layer, this is a chart penned a few years ago. It was called the FAT protocol thesis. And you don't need to believe all of this thesis, but at its core, it simply says that when we had the internet, the protocol layer was given away for free. And so there wasn't a lot of value captured in the protocol layer. Anyone in the world can use TCP/IP. It's an open source free protocol. And the value was captured at the application layer by Facebook or Amazon as examples. In the case of blockchain, the underlying protocols are not free because they have been tokenized and the tokens have been offered outwards. There is a concentration of value for Ethereum or Bitcoin blockchain in the hands of those people doing the work. And the logic there is that if you are, for example, a miner, and you're doing a lot of work to validate the blocks of the Bitcoin blockchain, then you should be rewarded. And unlike TCP/IP, which was given away for free, including to people that didn't help at all and did no work, in the case of blockchain, the benefits go to the computer scientists, developers, and people who operate and work the infrastructure in most cases. At least that is the conceptual theory of the FAT protocol thesis. So we do invest into new protocols. We believe that that's important to do. And interestingly enough, right now, we're seeing a new wave of very interesting protocol projects and teams surfacing. A lot of this is open source software, which means that you can build on top of the creativity of the past. So if you're a computer scientist, you can look at the code that is in Ethereum, or for that matter, Bitcoin's blockchain, and you can decide what you would change and what you would make better. In the old world, you can't hack into Microsoft code and take big blocks of it. That's called piracy and isn't allowed. But in the new world of open source software, that is how innovation occurs, at least to some extent. The second is this notion of the mainframe going to the cloud. And for us, this is certainly not the end of the journey. The cloud that we have today is not the end of innovation in computing. It happens to be much, much better than where we began, which was mainframe computing and then outsourced mainframe computing. Those were not very efficient, cheap, or accessible ways of doing computing. The cloud is clearly better. Any small business can gain the benefits of large computing capability and sophistication at places like Amazon Web Services, Google Web Services, or Microsoft Azure. But it isn't the end of the road. All of those are narrowly owned and centralized, and we're beginning to see new platforms. What would examples be? File storage at Filecoin, or shared computing at Dfinity would be examples, and there are many others. We're even beginning to see creative ways of sharing things like cell tower deployment so that individuals can put up a cell tower and be paid if it gets used. So there's a lot of creativity here. They are, I would say, embryonic, prototypical projects, but there is a lot of reasons for believing that decentralized distributed computing in certain applications will bring a lot of benefits over centralized approaches. That notion of distributing the network is fundamental, and these charts just make the point in a graphical sense. But when you have a centralized network of any description, you, as you can see on the far left-hand side, have a single point of failure, which is the center. You also have a single point of value capture, which would be a Google or an Amazon as examples. On the far right-hand side, you have a much more robust network. And as we've seen, robustness and the ability to weather disruptions is important in all networks, including in computer networks. And there are other reasons such as security, national security, that makes a distributed network in some respects preferable. Moving to the last of the three investment themes within the foundational layer, identity is still pretty old-fashioned. This is an ironic picture because that's a US official showing his passport to a Chinese official. And literally that passport needs to be shown. The passport is paper-based and it has a lot more content than you should need to show. No one needs to know all of the information that's in your passport. They just need an attestation that you are who you say you are. But we have not fully digitalized even something as fundamental as our international identity solution. By the time we get to things like driving licenses and birth certificates, in America alone, we have 5,000 or 6,000 different formats, and it's rather easy to create fake identities. And we are plagued by fake identity in today's internet. In fact, it's getting worse every day. And that's before we have issues such as breaching and phishing and spamming. So we need to upgrade identity solutions. When we're talking about human beings, we need immutable, portable, digital identity that can be used across applications. KYC AML in financial services is a good example, where every time you try and do anything with a financial institution today, you have to redo the work. You have to go back through KYC AML, whereas in fact, once you KYC AML'd yourself with one financial institution, they should be able to attest that you are who you are and that you've done that as you try and do it a second, a third, and a fourth time. Any of you who ever do an international payment will know that you have to get a phone call to check who you are some way in the process. And that's one of the reasons why it takes, 4 and 5 days just to transfer some money in the old financial system from one country to another. So identity is being updated and improved, but it isn't just a passive balance sheet item, if you will. Once you have high quality identity, you can also have provenance. You can track the history of a person or the history of a device and its usage and its ownership. When it comes to human beings, this is a cause of some concern, which is why this page is also very relevant. There is a concern that digital identity solutions could also be combined with your behavior and your financial behavior, and centralized governments, big brother, if you will, could peer over your shoulder and see everything that you were doing. So there is concerns about freedom and privacy and so on. But there's no question we will have digital identity and digital provenance too. And the question will be to what uses can it be put? Moving now to institutional monies and assets. This again is an image from China. It's the digital yuan being used at point of sale. All of the infrastructure to support the digital yuan was either new or recently new. They were clever enough to figure out how to let the digital yuan move over their newer mobile point of sale device capture hardware. And so they didn't require a complete new infrastructure to support the digital yuan. The digital yuan does not, in fact, use the blockchain. It uses a different set of technologies, but it works quite effectively. There is debate around the world whether or not we want sovereign issued digital monies or whether we want private sector digital monies, such as stablecoins. But what we know for sure is the use case works, and it works very effectively indeed. It does require new infrastructure. Stablecoins are probably the best use case right now at scale. They are highly controversial, but trillions of dollars is already being transacted across stablecoins like Circle and Tether. And they are simply able to do things that the traditional payment system can't do. You can move money with a digital stablecoin, a US dollar stablecoin, in almost real time at almost no cost, with a high degree of certainty and security. And I say that that is almost impossible under the existing infrastructure. Bank of America, in fact, in a recent analyst report, said that stablecoins are the greatest invention in the history of money. And we concur with that thought. Whether you think they should be issued by governments or by money center banks or by distributed innovative fintechs is obviously up for discussion. But the core technology is profoundly revolutionary relative to the way money moves today. And it's one of the reasons why we have seen such an acceleration in the usage of these new ways to transact money. Now we move up to the retail side, and we're going to talk just for a second about retail digital monies and assets. The digital natives rely upon their mobile devices for most of what they do. And if they have a digital device, and I've already pointed out about 2/3 of the world's population now does have a connected mobile device, then almost certainly, if they're a digital native, they want to use that device for their transactions. The reality is, in most of the world, that's very fragmented. The left-hand side here shows, for example, that you might have a bank account, you might have a payment solution like PayPal. You probably have your investments on an investment mobile app, TD Ameritrade shown here in the middle. And then if you are interested in digital monies, new digital monies and investments, you might have a Coinbase app as an example. So fragmented applications. And that isn't the way the rest of the world is trending. We're beginning to see the rise of super apps. WeChat and WePay is a Chinese example, powered by Tencent. Alibaba has something very similar, Alipay. And in both cases, you can do everything within a single app. So you can manage your money, you can invest, you can borrow and lend, you can even take out insurance in a single app. And that's the way the world is heading. And these super apps, we think, will be ubiquitous. In the West, we're beginning to see a few rise. Uphold has a lot more functionality, for example, than a traditional crypto wallet. So retail convergence of apps into more and more powerful apps, and the synergy on a super app is quite profound, because a lot of the activity is occurring within the same infrastructure. You're being able to net off transactions where you have both sides of the transaction occurring on the same platform. So we think that this is very powerful, very important. It isn't everything to do with retail digital monies and assets, but it's an example of why the functionality is so important. In America, and I know a lot of our listeners and investors are in America, we do struggle sometimes to see the value of digital monies, but most of the people in the world, it's very obvious, it's very clear to them. If you have lived in the Southern Hemisphere in particular, if you've lived in Latin America or Africa or in the Indian subcontinent and Southeast Asia, you're very familiar with monies that all of a sudden are worthless. And storing your value in traditional monies has proven to be a very bad thing to do. And so there is increasing interest in alternatives. And the dollar historically was a good alternative, as was gold. The digital version of the dollar, which is what a stable coin is proving very interesting across those territories, and Bitcoin too. So we don't know exactly how that will play out, but what we know for sure is that if you're in Venezuela or Zimbabwe, you don't want to use your own fiat currency. You avoid it as much as you can. And then DeFi. So DeFi is it's actually the sixth of our investment themes. We are very interested in DeFi. It is the computerization of everything I just described. So by the time you have not only the monies, the assets, the commodities in digital versions, and you have digital infrastructure to support their usage, then you have the option of decentralizing the infrastructure itself. And so you go from centralized digital commerce to decentralized digital commerce, and that's why we call it DeFi. We think it's very early days. We think there's a lot of risks associated with this space. The computer platforms, the computer software is still being built and tested, and there are risks associated with new software always. But it's very, very interesting what it's enabling, and we certainly want to continue to deploy capital into the DeFi space. Without question, legacy finance certainly needs an upgrade. I won't belabor that point. But DeFi seems to offer good possibilities around every dimension of the current legacy financial challenges and problems. And a very deep ecosystem is beginning to emerge, built on top of, as I already mentioned, open source software. So there's a lot of acceleration of learning as some engineers solve a problem over there, and other engineers are able to cut and paste that software into their own software over on the other side. And so we see an acceleration of their innovation as they work essentially in a collaborative way. Now we're going up to the top, the application layer. And I'm going to actually begin this in a different way. We normally talk about this from a different direction, but I'm actually going to start with the digitalization of assets. Because I do view that increasingly as a specific application. There are a lot of different asset types in the world. You can see this BCG chart breaks them out, equities, in funds, bonds, home equity, and so on. These are traditional financial assets. And it turns out almost all of those have paper-based records associated with them. In fact, the most important record for any asset is the ownership record. Who owns it? The certificate of ownership. And in most cases, most of those assets have paper-based certificates of ownership. Most funds, most private investments, and most real estate as examples. All of that will be digitalized. It's much more powerful to have a digital ownership certificate. It's more secure. It's more easy to trade. So you can actually put it into a digital trading environment. And eventually that means you can also get much more liquidity. So there are good reasons to digitalize the ownership certificate of traditional asset classes, but that requires new infrastructure, and that's what we invest in. And you can see here the predictions by Boston Consulting Group that over the next handful of years, trillions of dollars of the world's financial assets will have been essentially digitalized. When you speak to Fidelity or BNY Mellon, the world's amongst the world's largest asset managers and custodians, they survey their own institutional investors, and very large percentage of them do agree that the digitalization of financial assets is coming fast. So this is the most important use case. The world, every asset in the world has some ownership associated with it, and all of that is being digitalized. It turns out that it doesn't just have to be financial assets. So it turns out that every asset in the world also can be thought of as having been owned by someone, and there's provenance associated with the change of ownership that we need to track. And things like trading cards and collectibles, or fine art, or furniture for that matter, do need to have clarity around who owns them. And when we don't have clarity, we run into trouble, such as all the Second World War art that is still in debate about who owns it. Now, when we get to digital assets, such as in blockchain-based entertainment and gaming, or in certain areas of content and media where fan-based solutions are being created by the top artists to reward their loyal fans, it gets a little bit harder to get your head around it. A physical asset with a digital ownership certificate, I think most people can understand. But when the when the asset is born digital and also has digital ownership, some people are challenged by the idea that that can also be scarce. But having said all of that, NFTs is clearly the second big proven use case. Whether you believe that they have value or not, they certainly work. It is possible to issue NFTs, track who owns them, buy and sell them at great speed and low cost on a global basis. And that sort of innovation was not possible in the world of assets and finance heretofore. A very robust NFT ecosystem is building up. Again, it's not a single player. You need to be able to create, digitalize, transact, hold, store, etc. These types of assets, and that requires a lot of different infrastructure players to work together. And this is where, again, we're very active investors. And then on the enterprise side is much more complicated. B2B software is always much more complicated because, unfortunately, you are trying to take existing legacy activities and processes and digitalize them. What I just showed you a moment ago can be new software around new applications, but enterprise applications tend to be the digitalization of existing ways of doing things. And that's why we're showing you this page. These are accounting ledgers. And the problem with accounting ledgers is they sit on very, very old, in fact, thousands of years old technology. We still rely upon shared accounting ledger approaches that were used by the Medici and others hundreds of years ago. The very notion of an account is fundamentally flawed. The way accounting works today, there are two ledgers, yours and mine. No one else in the world gets to see them. And I record the transaction I do with you, and you record the transaction you do with me. And it's invisible to everyone else. And when we have to audit it, it takes a lot of time and energy and work. The notion of having a distributed ledger technology is that there's actually a third ledger. There's a publicly visible ledger. There's your ledger and there's my ledger. In fact, you don't and I don't actually have to have a ledger, but let's assume we do have them. We now have three ledgers, and we write every transaction to the new third ledger, which is visible to everyone. And that notion of a distributed shared public ledger is absolutely transformational in everything that we do in the enterprise world, because almost all of the costs associated with global activity rest on the complications of having entire industries and in networks and ecosystems of businesses having to share information in very antiquated ways. And a distributed shared public ledger transforms it, whether it be the educational system, the health system, or any other industrial system. Just to give you the example of the educational system, because I think it's such a good example, we have a congressman here in America who got elected whilst lying about every aspect of their education. It was all fake, none of it was true. With a distributed shared public ledger for education, you would be able to see, did that congressman really go to these schools and universities he claimed to go to? And presumably he would not have got elected when everyone discovered he was a liar. So the implications for accounting are profound. Things like the audit go away. You can do real-time audits if you have real-time updated digital ledgers. And that is very, very important for the accounting profession, but it's also true in every aspect of compliance. Real-time, low-cost compliance checking would take away most of the work of organizations such as our SEC or our IRS, where we pay tens of billions of dollars to have people wade through paper. So these are the 8 investment themes. And the question for you as an investor is, do you believe that these themes will innovate the status quo? And in our minds, the answer to that question is profoundly yes. We can't imagine staying where we are with a world of digital communications and digital content, but paper-based commerce. So we will digitalize commerce, and it will require the upgrading of all of the world's financial infrastructure. And so then the question is, where are we in that process? And fascinatingly enough, we do think that the internet chart that I showed you from the 90s and the zeros is where we are in the case of blockchain too. If you look at the lower half of this chart, we had a bubble building, we had rampant speculation, the bubble has burst, but that does not mean the innovation has stopped. And we and other blockchain venture capitalists are still investing every day in new projects and new opportunities. And that's why we will be issuing our next fund of funds. So this is our investment platform. I don't have time today to go through all of it. What's in bright blue are the open investment opportunities for accredited investors only. And we will be launching our next fund of funds in the next month or so. I won't say anything more about this on this open webinar, but if you want to contact us and learn more, you know where to reach us, ir@blockchaincoinvestors.com. And there's a lot of resources at our website, blockchaincoinvestors.com, in the inside section. So if you're new to everything I've just described, please do go to blockchaincoinvestors.com and hopefully subscribe for our newsletters and webinar series. You may already have done that. And with that, I'd like to thank you all for sharing your time today. I hope this was useful. Don't hesitate to reach out to us if you have questions. And with that, I will close down this webinar.